Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team, and I welcome you all to another session of Commodity Catch-up, where we'll discuss major market developments as well as price outlook for major non-agriculture commodities. A shaky start and a positive finish is how we can describe the commodity market performance last week. And once again, the key price determining factor was the US dollar index. Gold once again slipped below the key 1700 level but recovered to end with a marginal gain, while silver registered a sharp short covering rally as the US dollar index succumbed to profit taking. Industrial metals also managed to end higher, with the exception of aluminium, amid improved risk sentiment and supply related issues. Crude oil recovered from January lows but still ended in the red. Continuing with the recent trend of switch between riskier assets and the US dollar, commodities and equities found some footing last week as the US dollar index succumbed to profit taking. The US dollar index started on a firmer note and tested a fresh 2002 high, but failed to hold on to the gains and ended lower, marking its first fall in 4 weeks. The US dollar has risen lately as a number of Fed officials, including Fed Chairman Jerome Powell, has indicated that aggressive rate hikes may continue until inflation comes under control. The US dollar, however, succumbed to profit taking amid reduced safe haven demand and monetary tightening by other central banks. Global growth outlook remains mired by mixed economic readings, China's struggle with the virus spread, and monetary tightening by major central banks. Despite this, risk sentiment improved last week as inflation concerns eased somewhat and as central banks failed to surprise. Market players are becoming hopeful that central banks may slow down if inflation situation improves. Inflation pressure remains high globally. However, market concerns ease somewhat amid correction in energy and commodities prices at large. Crude oil prices slumped to January lows last week on demand concerns, while European gas prices tested 1-month low on improving stock situation and increasing efforts to control prices. China's inflation data also showed easing price pressure as consumer and producer prices rose less than expectation. Central banks across the globe are raising interest rates to bring inflation under control. In a largely anticipated move, ECB last week raised interest rate by 0.75% to accelerate its fight against inflation and promised further hikes. ECB President, however, took an open-ended approach on future stance. Australia's central bank raised interest rate by 0.5% last week in line with expectation. However, it also took an open-ended approach on future moves. Again in line with expectation, Canada's central bank raised interest rate by 0.75% and indicated that rate hikes may continue. While commodities got some footing, concerns about Chinese economy rose amid mixed economic data and persisting virus concerns. While Chinese inflation data showed easing price pressure, trade surplus narrowed more than expectations due to slower exports. A number of Chinese cities also continued with virus-related restrictions to limit the virus spread, hampering economic activity. Going ahead, we may see volatile trade continuing as market players assess monetary policy stance of major central banks as well as outlook for Chinese economy and Europe's energy crisis. The key event in the coming week is US inflation data as it will help form expectation for Fed's upcoming meeting. Expectation of a 75 basis point rate hike has already been factored in, but inflation data may affect future outlook. China's industrial production and retail sales data may also reflect upon health of the economy. Also in focus will be virus situation as it will help factor in how long the restrictions will remain in place. Europe's energy prices are also likely to remain volatile. European leaders have discussed various ways to control prices and curb demand, including a price cap on Russian energy. However, they have failed to agree on any concrete measures. Meanwhile, Russia has warned that it will halt supply to any country which imposes a price cap. Let us now look at individual commodities. Gold traded in a narrow range near $1,700 and ended marginally higher, gaining support from correction in the US dollar and bond yields. However, weighing on price was monetary tightening by major central banks, correction in energy prices, and continuing ETF outflows. Gold has managed to hold near 1700 level. However, we may not see much recovery as the US dollar may remain supported ahead of Fed's upcoming meeting. Silver witnessed a sharp rise amid concurrent gains in gold and industrial metals, while ETF inflows showed some buying interest. Silver's sharp fall made it vulnerable to short covering move. However, it may not continue for long as both gold and industrial metals face challenges. In industrial metals complex, base metals mostly traded on a positive note, supported by weaker US dollar and supply disruptions in some metals. Also supporting price was hopes of additional stimulus by China as easing inflation pressure gave central banks more room to act. Copper benefited from strike in Chile's Escondida mine, lower production guidance by Codelco, and robust imports from China last month. Aluminium tested 17-month low but managed to recover on concerns that aluminium smelters in China's Yunnan province may be subjected to power rationing, hampering production activity. Going ahead, industrial metals may see some weakness as investors turn cautious near key US and Chinese economic data. Zinc and aluminium may find some support from lingering European gas crisis. In energy complex, NYMEX crude slipped to January lows but recovered to end with marginal losses. Crude oil weakened on demand concerns and sharp rise in US crude oil stocks. However, supply risk relating to Russia and recovery in equity markets lent some support. Crude oil may remain volatile as demand concerns counter supply risk. However, we suggest waiting for corrective rebounds to create fresh shorts. Natural gas fell for the second consecutive week, weighed down by bigger than average rise in US gas stocks, near record US gas production, and expectation that weather-related demand may subside during the fall season. A sharp correction in European gas prices also weighed on US gas prices. Natural gas has corrected over 20% from recent highs, reflecting weaker sentiment, but we expect buying interest to emerge at lower levels amid tightness in US and global market and amid continuing supply risk relating to Russia. Well, that's it from my end. I wish you all a very happy trading week. Thank you.